When I saw it in 1998, sorry, when I saw it in 2008, I wasn't even reading all the story. Like, I know this movie, I know how this ends. But yeah, Lehman, sure, big deal. But go back again, this goes back to what I said about 98. It started in 97. These markets are so large, the scale of the system is so large that it can take a year to play out. You have to understand the dynamics to understand that. And most people on Wall Street don't, because they're using badly flawed models and regressions and normal distributions of risk. I said none of that. It's all garbage, but that's what people use. But if you understand complexity theory and complex system dynamics, you also understand that it takes a while to play out. An avalanche starts with a snowflake and ends up burying a village. You're supposed to be looking for the snowflake. And in 1998, 2008, that started in 2007, August 2007. There were two Bear Stearns hedge funds that went, illiquid, basically, suspended redemptions and closed their doors, and a money market fund at one of the big French banks, Société Générale. But that was not Bear Stearns itself. That were the Bear Stearns hedge funds. Bear Stearns didn't bail them out. Typical Bear Stearns. Believe me, Bear Stearns refused to participate in the 1998 bailout of long-term capital. So when they went down in 2008, I promise you, no tears were shed on Wall Street, because that was like, what goes around comes around. It was the attitude. But so that was the start. But remember, Bear Stearns itself failed in March 2008. Then by June, it was Fannie Mae, Freddie Mac. And then in August, the Congress passed a bailout law for Fannie Mae and Freddie Mac. I was advising the John McCain campaign at the time. And I was on a call, and they were like all high-fiving, like, yeah, the crisis is over. Congress bailed out Fannie Mae and Freddie Mac. We can get back to talking about the war in Iraq, because that's what we really want to talk about. And I, skunk at the garden party, I said, guys, you're not going to make it to election day without this getting much, much worse. I didn't say, September 15th, Lehman Brothers, although everyone knew Lehman was the weak link. I mean, that was true in 98. That was always true on Wall Street. They were always the weak link. But I said, you are not going to make it to election day without an exponential increase in this crisis. So why don't you get ready for that now? Write your speech, have a 4-point plan. It doesn't matter what the points are, just have them. And put your guy on the steps of Treasury and reassure the American people you'll win the election. I was laughed at, not invited back. I'm used to that. And then when it came, McCain runs around like a chicken with his head off, barging into the White House, demanding an emergency meeting. Well, Bush says, well, I can't invite McCain in without inviting Obama in, which he had to do. He didn't want to pick sides in the campaign. And there was a cabinet meeting, and Obama didn't know anything either, but he was smart enough to keep his mouth shut. And McCain's running around. So American people looked at that and they go, you're nuts. You kind of look calm, cool, and collected. If you look at the polls, they reversed. Obama was behind until Lehman. And then after Lehman, and days later, Obama went ahead in the polls. So that was a turning point in the election. But it's, and then, so getting back to 2008. So when Lehman came up in September, it was September 15, 2008, that was like the fourth domino, not the first. Everyone remembers it. Oh, that all fell apart after Lehman. Well, it did, but you could see that coming a year away. And Morgan Stanley was days away from collapsing. Goldman would have been right behind it. Then probably Citi, whether JP Morgan would have been the last guy standing, don't know. But there were many more dominoes to fall. And that's when Bernanke and Hank Paulson walked over to the White House and said, we got to do something. And they did. What they did is overnight, they converted Morgan Stanley and Goldman Sachs into bank holding companies. Now, I've been a securities lawyer and bank lawyer for decades. And when you do applications to the Fed, depending on the politics, it can take a couple of years to get something like that approved. This was done like in a day. But the reason it was done was that the Fed could bail them out. Once they were bank holding companies, the Fed had the statutory authority to bail them out. They did. Then things calmed down and we had a bad recession. And AIG was another wild card in the deck. But my point is a couple of points. Number one, you can see these things coming if you know where to look, but most people don't. Number two, they take a while to play out. So you get plenty of warning. But again, people ignore the warnings. And then finally, and it's important to understand there's a difference between a financial crisis and a recession. They're both bad, but they're two different things. 1998 was a severe financial crisis, but there was no recession. I mean, the NASDAQ hit an all-time high on January 1st, 2000. It went on for another year and a half, and there was no recession. 1990, 91 was an example of a recession, but no financial crisis. Some losses in commercial real estate, but there was no financial panic. 2008 was both. 2020 was a severe economic contraction. It's technically a recession, but it's kind of hard to know what it was. It's like, Anthony Fauci shut down the U.S. economy. So what is that? GDP fell 32% in one quarter. Technically, sorry, 2 quarters. Technically, it was 2 quarters, but it was really 2 months, March and April 2020. But March happened to be in the first quarter, April was in the second quarter, so it took both quarters down. But that was really concentrated in about 2 months, and then it kind of came roaring back. But I call it a severe recession, contraction. But there was no financial panic in 2020. The stock market went down 30%, but it like doubled from there. So so these things can come together, and we're almost certainly in a recession now. The recession will get worse. So that's not priced into the markets, but you don't even have to guess. That's here. It's going to get worse. The question is, are we in for a financial panic? That's kind of what you were referring to, Brian. And the evidence is yes. The evidence is right in front of your face if you know where to look, but most people don't. It's a little bit technical. I can explain it in plain English, but the signs are there.
Okay. And I guess you go a little bit deeper to this in your separate video, Countdown to Crisis, where you talk about how this crash is going to be fast, bloody, and unavoidable. There's a link below, londonreal.tv/Jim. You also talk about position yourself to profit for this crash in 2022. Do you want to give us any hints about how that's right in front of our face, or should they go watch the video for that?
Well, I can give you more than a hint. Like I said, these things, they're often presented technically because some expert wants to seem smart or whatever, but you can do it in plain English. So basically what we're talking about, the warning signal, and it's a bright red flashing light, is an inverted yield curve. So what does a normal yield curve look like? So the x-axis is time, and the y-axis is interest rate. So, and treasury market's a good example, but there are other markets. I'll get to one in a second. So what are the maturities of treasury? Well, it's 30-day bill, 60-day bill, 90-day bill, 1-year bill, or 360-day bill, 2-year note, 5-year note, 7-year note, 10-year note, 30-year bond. So that's your x-axis. And interest rates they can be negative, but kind of 0 to whatever. A normal yield curve is upward sloping. It's the longer the maturity, the higher there. And that makes perfect sense. If I'm going to lend you money overnight, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I might say, hey, Brian, you got to pay me a little more because, I'm taking more risk, et cetera. Perfectly normal upward sloping yield curve. And whether it's steep or flatter, okay, that's important if you're a trader, but upward sloping. But an inverted yield curve is downward sloping. An inverted yield curve says future interest rates are going to be lower than present interest rates. Well, why would that be? If I'm lending you money for a longer period of time and I want a risk premium and protect myself, why would I take a lower rate? The answer is because I think really bad things are going to happen. And I don't mean me personally. I mean, this is the institutional market. So, and we see this in the treasury market. It flips around day to day, but right now you have an inversion in kind of 2 years to 5 years. So a 5-year note is yield to maturity is lower than a 2-year note. And you see it in 7s to 10s. So the 10-year note has a lower yield to maturity than the 7-year note. It's not that the whole curve's inverted, but it's in sections. It is. So at the short end of the curve, 30, 60, 90 days, 1 year, yeah, it goes up. Well, that's because the Fed controls that part of the curve. They already told us what they're doing. We know they're going to raise 75 basis points in July, at least 50 in September. We'll see what happens in November. And then they have another meeting in December. But there's no reason to think the Fed is not going to remain on this path of 50 to 75 basis point interest rate hikes for the remainder of the year, which is going to get interest rates of 4%. I remember when they did this from 2015 to 2018, late December 2018, they went from 0 to 2.5%.